Hello friends, welcome to my channel Impart Knowledge. If you are new to this channel, consider to like, share and subscribe. Also press the bell icon to receive notification whenever a new video is uploaded. Let's get started. In this video, we will discuss about meaning of insurance, principles of insurance, difference between life and general insurance. Meaning of insurance: an arrangement by which a company or state undertakes a guarantee of compensation of a specified loss, illness, damage, or death in return of a specified premium. Now, what does this mean? So, insurance means compensation. Now, this compensation is given by the insurance company against a specified loss for which company charges a premium. Now, it's a contract between the insurance company and the insurer. So, it's a guarantee that in case of a specified loss, insurance company will pay compensation to the insurer. Principles of insurance. So there are 7 principles of insurance. We will discuss each one by one. Utmost good faith. Both the parties in an insurance contract, so that is the insurance company and the insurer, should act in good faith towards each other. Now this means that in the policy, the insurance company must lay down complete information, complete terms and conditions in the policy document, and at the same time the insurer must disclose the factual information while applying for the policy. There must not be any hidden information either by the insurance company or the insurer. The next principle is insurable interest. The insured must have an insurable interest for which an insured enters in the insurance contract. So, for example, let's say if today I buy a home insurance. Now, if I'm buying a home insurance, I have an interest in my home, hence I will go ahead and buy home insurance. But I will not buy home insurance for neighbor's house. Why? Because I'm not interested if there is any loss or damage that happens to the neighbor's house, but I'm interested in my own house. Hence, I have an insurable interest in my own house. This is called insurable interest. The third principle is proximate clause. So, it applies when the loss is result of 2 or more causes. The insurance company will find out the nearest cause to the loss of property. If the proximate cause is the one in which the property is insured, then the company must pay compensation. So, for example, let's say an intoxicated motorist causes an accident. So, while riding, he was waving his hand towards his friend, and in that moment an accident happened wherein the motorist has hit another car. So now in this example there is a connection. The connection is the person driving under the influence of alcohol and the accident happened. So there are 2 causes. One, influence of alcohol, and accident. Hence, the insurance company will go ahead and pay compensation. The next principle of insurance is indemnity. Insurance is done for coverage of loss and not for profit making. The insured must be compensated for the amount equal to the loss and not the amount exceeding the loss. So, indemnity principle is for general insurance. which clearly states that if there is a loss or a damage that happens, only the amount, the compensation would be paid for the amount which is equal to the loss. So, for example, let's say if my loss is of 1 lakh, I will be paid 1 lakh and not 2 lakhs or 3 lakhs. I will get the compensation for the actual loss amount that has happened. So, this is not for profit making. The next principle is subrogation. It means one party stands for another party. It gives the right to insurance company to claim the amount of loss from the third party responsible for the same. So this means that it gives right to the insurance company to recover the payment of the claim that has been paid to you from the third party. If the damage or loss has happened because of third party, so the company has the right to recover the money from the third party. But your insurance company will definitely give you the compensation and will claim that amount from the third party. The next principle is contribution. It applies when the insured buy more than one policy for the same subject matter. Again, it applies for general insurance. So, let's take an example. Let's say if there is a property of 5 lakhs and there are two policies. One is for 3 lakh from company A and the another is for just 1 lakh from company B. Now, in case if there is a damage to the property, for 3 lakh, full claim can be claimed from company A. But then the person will not be able to claim from company B. In fact, company A will go ahead and can claim proportional reimbursement value from company B. So this is how the principle of contribution works. The last principle of insurance is loss minimization. This means the insurer must take necessary steps to minimize the loss to the insured property. So let's say, for example, if there is a fire in a factory, so the person must not step back and not take necessary step to put down that fire. In fact, the person must ensure how he can minimize the. Let's further discuss more about life and general insurance. So what is the difference between both of them? In life insurance, it's a contract which covers the life. General insurance is absolutely opposite of life insurance. Life insurance is a long-term contract. Now, when we say long-term contract, this could be either for 5 years, 10 years, 15 years, 20 years, or even for more. Wherein general insurance is for a very shorter tenure. So, this could be for 1 year, 2 years. Now, in life insurance, like we had discussed in the previous slide, a sum of money is paid either in case of death or at a certain point. So, life insurance is a form of investment, wherein general insurance is a contract of indemnity. So, indemnity means this is a guarantee given by the insurance company for compensation in cases of losses or damage. In life insurance, you have an option to pay your premium over the years. For example, if I want, I can pay my premiums either on a regular basis till the time I have my policy, or maybe I can just pay for 5 years or in a longer duration. So basically I have that option to pay my premium in a longer tenure, wherein in general insurance that is not the case. In general insurance, I will have to pay a lump sum amount. So if it's a annual contract, in that same year I will have to pay my premium.